Terrific. Well, hi everybody. My name is Jay Rao. I'm an emergency physician and I'm the immediate past president of the Hillsborough County Medical Association. I want to thank you all for spending some of your time this evening with us. We are very grateful to have one of our outstanding business partnerships with the Physicians Wealth Planning Group. We have with us Mike Jensen and Jeff Anderson and Jason Hamblin. And these guys have a wealth of knowledge. And you know, the financial aspects of medicine is not something that you think about much when you're a med student, but you know, you've got a lot to learn, obviously, about learning how to be a physician. But as these guys will explain when you get out, and I can tell you, you know, to create a successful practice and to basically plan the rest of your life, it's really a good idea to start thinking about these things early. And Mike actually works with residents at USF in a business, basically about the business aspects of medicine. He's been teaching residents and fellows the business side of a medical practice. And this is critical information that I didn't get a whole lot of when I was in training. And so it's great that you guys are here. Definitely ask a lot of questions and take full advantage. And gentlemen, we appreciate your time and your expertise. So take it away.
And how about if I introduce ourselves? I just want to say something before we get started. I have been on the faculty over at Mersani now for, geez and criminies, like 25 years. When Jeff and I teach at conferences or different classes, we use a technique called a conversational method. We'll speak back and forth to each other, ask each other questions and answer it. And we encourage you to ask us questions that way. Good questions equals good learning. And that's what we're going to do. We're going to speak in English. We're not going to speak in financialese. You know, if we start speaking as though you can't understand us, you got to let us know right away. So we're going to do a conversational method, and please ask questions. That's how you'll learn the most. Jeff?
Yeah, before we get started, just a couple housekeeping items. This is a 2-week course, so we will be here same time next week. And we'll be covering estate planning. We have another guest speaker next week who's an attorney. And then we'll be covering investments and risk management next week. So you also got some books sent to you. The books correspond with the slides. We don't cover every slide, every page in the book. But we do skip from page to page. So if you get lost, you know, just follow the presentation. The page number is in the upper right corner of the presentation. So I think we can get started. Mike, go ahead.
Okay. As we start looking at this, you're going through certain stages in life. Okay. There's many things that you're going through now, and you want to move that slide, Jeff. Okay. There's different things that have to be done in life planning. Okay. There's education, personal welfare, career, business. Tonight, we're going to address finance, physical finance, and ways to accumulate wealth. You're at a certain time in your career that there are decisions you're going to make. You're in your early years of your practice. Most of the people in this group this evening are in the early years of the practice. So there are certain good habits that you need to take care of on the financial side. So let's move on to the next slide and just talk about a couple things.
Yeah, life planning. You know, life planning is often overlooked. You know, this is kind of the part that a financial advisor can't really tell you. And this is just really, how do I want to live my life? You know, and what's really important to me, and things I want to accomplish in my life. You know, that really gets into setting goals. Are you guys, is this feedback really so bad again, Dr. Rao?
I can hear you fine, Jeff.
Can you guys hear me? All right. The reverb just sounds, I switched computers, so all right.
It echoes a little bit. So if people that are not speaking mute, it might help a little bit. We can try that.
Okay. Yeah. So, all right, good. Mike, why don't you cover the smart setting goals under the SMART method?
Right. when you set goals, they have to be doable. They have to be specific. What the heck is it that you're trying to accomplish? We may be talking about finance this evening. So they have to be specific. They have to be measurable. You can't pick things out of the sky that you can't measure, or you'll never know whether you're going to accomplish it or not. They have to be aligned. That means if I want to hit these goals, what's going to, what would stop me? Very importantly, they have to be realistic. And one of the comments I'm going to make, because of the people in this audience this evening, I know what your incomes are going to be. We deal maybe starting with the residents, but our clients are pretty much all in practice. You don't have a lot of things that aren't realistic financially if you manage your money properly. Another thing is you need a timeline. You need to know what you're going to do and when you're going to do it. Basic things, they have to be simple.
Yeah, so I'm just going to give a couple examples. It has to be specific. Maybe I want to save up for my first home, which is important. But when you're starting out as a younger physician, you may be moving around a lot, so maybe a home isn't that important to you. But you want to set goals. Maybe I want to retire at age 70. That would be another example. Maybe I want to have my children's education paid for by the time they start college. Those are all very specific goals. Measurable. Well, if I want to save for a new home, and maybe that new home's $600,000, and I want to save a couple $100,000 for a down payment, how much am I going to need to put away on a monthly basis over the next several years to get to that number? Or in relation to retirement, if I were to retire at age 70 and I want to live off $200,000 in today's dollars, how much do I need to set aside on a monthly basis in order to hit that retirement goal? You also want to make sure you're aligned, like the whole family wants to buy into this. Maybe you want to buy a second home or a first home, but you want to talk to your spouse or your partner to make sure that they're on the team too. So going through these exercises is going to help be the catalyst for those types of conversations. They need to be realistic in the sense that you need to be able to afford those goals. One thing that we see a lot of when you start to really start to make money in those first several years, it's real hard to pull the reins back and not go out and buy those real expensive items like the home, the boat, the car. You want to make sure that you do some budgeting, and that's what we're going to talk about next. And by doing a budget, you'll be able to realize, are these goals realistic, and do I actually have enough cash flow to do it and not impact myself down the road? And then also a timeline, usually a set date. Like in the retirement example, if I'm age 70 and I want to live off $200,000, I'm probably going to need, several $1 million. Okay, but that's a definable goal that I'm setting for myself. All right.
Yes, and as we sit here and we look at these different things, sit back and take a deep breath right now and just say, what will your future say about the decisions that you're making today? Because the things that you're doing today are going to affect you for the rest of your life, especially in finance. So these are not short term. These are very important things that are going to affect you for the rest of your life.
That brings up a good point. The first step in developing good financial habits early is to create two documents. The first document is a net worth statement. Mike, why don't you explain the net worth statement?
Yes. CFPs, CPAs, their Bible begins with the two statements that Jeff just mentioned. The first is a personal financial statement of net worth. The net worth is you just sit down and you write all of your assets, then all of your liabilities, and what do you have left over? That's your net worth. That's an easy thing to do, especially in the basics. But if you have to know what you have to start if you're going to try to achieve a goal. The other major
Mike, if I could talk about the net worth statement before we head on. The net worth statement, to make things a lot easier, there are aggregation portals out there. There's mint.com. We use one in our practice. And what this enables you to do is link all of your accounts so you can see it in one portal, and it automatically calculates your net worth every day. So that will help ease the pain of trying to log into all those accounts and track them. It updates real time for you. And at a minimum, even if you don't do that, then when you do your annual review for your financial plan, that's when you need to update that net worth statement. And when you dissect your net worth statement, there's really two components. There's your fixed expenses, and that's my housing, feeding my family, saving for my children's education, saving for my retirement accounts. Those are all necessary things. It will also separate your discretionary spending. And this will help you understand your budget and all that. So we're going to talk, actually, I jumped ahead on that one. That was the cash flow. Sorry. So
Right.
that work's done. I jumped ahead. Sorry. Get on to the cash flow statement. Mike, why don't you talk about cash flow?
Cash flow. I'll say a bad thing about Jeff first. Jeff helped create a cash flow page. It's very long, very complicated when you first look at it. But if you don't list down what your cash flow is, what money really comes into you, and what are really your expenses, if you don't put that in writing and see it, you're flying blind. So you've got to do a cash flow statement. You list your expenses, you list your income, and what's left over is what you have to work with. You're going to see a diagram in a moment that's going to show the right way to construct in finance and spending and the wrong way. And we won't spend a lot of time on it, but if you go to that, Jeff, they'll see what's important.
Absolutely. Yeah, I jumped ahead of myself on that one. The cash flow statement, we have an actual cash flow budget worksheet that if you want, we can email it to you. It's in Excel. So you can run all these different models of your expenses. And that's what I was talking about in the fixed versus discretionary spending component. I want to know what my fixed expenses are, my discretionary, because I can always pull back my discretionary, but I want to know how much on a monthly basis am I going to be able to stay on track of funding all my goals for retirement, saving for the kids' education, saving for maybe my first house or a vacation home. And then that excess money, I want to know what that number is that I can spend on the fund money part of that. So we can email that over to you. And that's a really crucial part of all this is the budget worksheet. And this is just kind of an example of one. This isn't the actual one we have, but those two documents are extremely important. Net worth is what do I have now? What are my liabilities? And hopefully my net worth's going up every year. And then the cash flow, is the money coming in? Where's it going? And is it going in the right places?
If you get nothing else from this meeting this evening, you need to get these two statements done. You want to use a professional to do it, but you don't need them to do the rough outline. You're the one that has to do the rough outline. This is basic. Oh, Jeff, before you go past this one, I want to make a comment on this slide. Don't get fooled by how much a physician earns. Just because they earn a lot of money, it doesn't mean that they're saving for retirement, that they're going to be financially independent. One of the mistakes that people make, especially physicians, because they don't have any training in this before they come out like lambs for the slaughter. You can keep putting money in and money in, but if you've got leaks in it by bad money management, you can't recover from it. So just because somebody's living in a big, beautiful house, don't think that they're going to be financially independent. Don't judge them by their car. You've got to make sure that you are wise in the way that you construct your spending. Sorry, Jeff, go ahead.
Yeah, we work with a lot of physicians who've made the same amount of money for 20 or 30 years. And the difference between the physicians who have $10+ million versus the physicians who might have $2 or $3 million is purely amount of money that they saved and didn't get in the whole keeping up with the Dr. Joneses and trying to buy these big homes, buy these big fancy cars, because they just try to get in that lifestyle and it just doesn't work. Because once you get up there, it's very hard to go backwards.
Yeah,
it's very
there's
hard
nothing wrong with spending like that. There's nothing wrong with that. You just have to do it within your parameters. Don't worry.
Exactly.
You're going to make enough money to achieve your goals if you're wise.
Yeah, it seems like we're being very aggressive about this, but the key here is that we see it all the time. It's like an athlete who starts to make a lot of money, for the first time. They get a little caught up in that. So the takeaway is here, all those things will come. You just got to wait and make sure you get good habits in the beginning of how to save. That's the key to all this stuff. So this is just kind of ties into the goal setting. This is, let's say, I'm going to retire at age 70, and we always do our retirement analysis to age 100. So if I've got 30 years in retirement and I want to live off of, in this example, $100,000 a year, how much would I need to have in my nest egg in order to produce that $100,000 for 30 years. And they give you a 6% rate of return. So as you can see here, it's about $2 million you would need in that nest egg in order to produce $100,000 a year of income. So if I wanted $200,000 a year of income, I would need $4 million to last for 30 years in retirement. So retire at 70, plan to age 100, that's 30 years. I would need about $2 million. All right. So how hard is that? That seems like a really big number to me. It's really not, because if you look at, maybe you're 40 years old and you've got 30 years to retirement, and then you retire at 70, right? So if you look at this chart, and let's say your assumed rate of return is 7%. That's kind of a normal return for somebody in their 30s, 40s. You need to save $815 a month for 30 years to get to $1 million.
And that's nothing.
That's nothing. $1,600 a month to get to $2 million. That's nothing. You know, you guys are making a lot of money. I know it seems a little overwhelming that you might still have some school debt, but once that's done, you know, $1,600 a month isn't too challenging. You're doing that just by maxing out your 401k plans, which we're about to talk about.
Hopefully.
Right. So just starting early. This shows the value of time, the time value of money. What's your wealth accumulation formula? You can talk about this list of things here, Mike.
Yes. These things are the basic things for you to start to create wealth or to have money. You need effective wealth planning and budgeting. That's what we're talking about tonight. You need debt reduction. Let's just for a second, Jeff, I want to go over and speak about medical school debt. Physicians work up a ton of medical school debt, but don't worry about it because the physicians pay it back faster than any other group in the country. A personal friend of ours and who speaks to our physicians in the different conferences that we run is the head of the Southeast with Sally Mae, who controls the physicians' debt. And they have so many ways. In fact, geez, we can put you in direct contact with her if you have any questions about your debt. That gets paid. Don't worry about it. Okay? Tax efficiency. That's why you've got a CPA here, because everything needs to be done with a team. Jeff doesn't know everything. I don't know everything. You don't know everything. But if you work with the team, tax will get done properly. Proper mitigation, return on investment, return on investments. If you have a fun account, you want to get in the market, that's great. But with your serious money, please work with professionals, okay? Inflation, we discussed inflation earlier, how important it is to make sure that you are gear your targets with inflation in mind. And then there's ways you take out your distributions from the money that you've accumulated. There's a right way and a wrong way. The right way is going to be a tax efficient way. A wrong way is not. And then you also have to look at fees. Okay. They're the basics. Good, Jeff. Sorry.
Yeah.
Oh, can I make a comment on this one? I'm sorry to keep going. These two cycles Jeff pointed out to me earlier today are excellent. Here's the wealth destruction. Wealth destruction, they have poor budgeting. They have higher taxes. Their expenses are higher. They have a cash shortage. They get in credit card debt. The debt grows. They have interest expense, and it's a vicious circle. Jeff pointed that out earlier. In a wealth construction, why don't you discuss that part of it, the right way to do it, Jeff? Absolutely.
Absolutely. It just goes back to budgeting, really. You know, you've got cash inflow coming in. You try to pay as little in taxes by saving money through some tax deductible savings vehicles, things like that. Saving money, growing the assets, and then you've got a nice nest egg of money that just starts to compound and compound and compound. And this all goes back to paying yourself first, understanding your expenses. That's the key here, is understanding the lifestyle you're trying to achieve, understand how much money you got coming in, how much money you got going out, and what's important to you, and setting those goals early on and creating good financial habits. That's how you create wealth.
That's the difference between a $2 and $3 million physician or a $17 or $20 million physician.
Absolutely.
Just, if you just did what that said.
Absolutely. So we're just going to cover some 14 wealth planning mistakes that we see that are common. And we go back to the lifestyle planning just really trying to envision what your life is going to look like going forward, and not making decisions just based on emotion and being spontaneous, but making good financial decisions that are planned out. That's really the key there on that one. Mike, you want to talk about number 2?
Yes, I'll tell you one thing I want to talk about with this. The top 14 wealth planning mistakes, every one of these problems or mistakes that are being made are all negative. Some things that they didn't do, or they said they couldn't do, okay? It is possible. If you set financial goals and you meet lifestyle goals, that is so significant, because where you are right now, especially if you're in your younger years, is going to determine what you have at the end. If your lifestyles are correct, and we're not talking about starving, we're talking about living a good life, but sensible and saving, learning how to, as Jeff says, learning how to steal from yourself. That's a secret. Yeah, Jeff.
Absolutely. Yeah. Number 3 is just committing to be financially successful. I think everyone's taking a step in the right direction just by attending this course at 6:30 at night on a Tuesday. You know, it shows that, and it shows that you're committed, and you're taking the time to learn, and that's everything. For learning early on and educating yourself, I mean, I give you a lot of credit for taking that first step.
Yeah, number 4 is pretty easy to answer, because this group that we're talking to tonight is here to obtain financial education.
Absolutely. Absolutely. We talked about taking an inventory earlier. That's really the first step in developing a good financial plan, which is, where am I in the net worth statement, and where's my money going in the cash flow statement? Like I said, we can email you an example or an actual budget worksheet for the cash flow, if that's of interest to you. Managing credit. Mike talked a lot about the school debt, and we understand that. We're going to talk a little bit about good debt and bad debt here in a minute.
Bad debt, yes.
Yeah, we'll talk about that in a minute. So let's just jump off of that one. Seeking financial advice. Mike, you want to cover that?
Yes. You can't do these things by yourself. I know we alluded to this earlier, and maybe there is redundancy throughout this conference, but redundancy brings retention. The thing is, you cannot do it by yourself. I can't do it for you. Jeff can't do it for you. Your CPA, Jason, couldn't do it for you. We work as a team. You need a CFP. You need a CPA, and you need a good attorney. You can't do it yourself, but you are the one who funnels the information into your professionals, and they're the ones that help you design it.
Absolutely. A highly credentialed team. If you choose those teammates, so to say, early on, and they all share the information and start to build with you and grow with you, that's extremely, extremely important. And you need a highly credentialed individuals, you know, in the financial space, CFP designation at a minimum, and a CPA in accounting, and then on the legal side, you know, attorneys that actually specialize in estate planning and all the other stuff that you may
healthcare.
Healthcare, absolutely. Yeah, absolutely. That's a good one. Mike, number 8, investing early and regularly.
Okay, if we wanted to end this meeting right now and not have a meeting next week, the only thing that you had to remember from hearing this group of people speak is to learn how to invest early and regularly. It's good financial habits to learn how to steal from yourself. There's 2 ways to accumulate money, okay? One's inheriting it. And then believe me, that's a whole different set. It's a whole different set of things, because we do have some of them. But it's the other way is by education and working smart, investing regularly, starting right away. Use the tax laws, and Jason will get into that more. You have to allocate your assets properly. It's all things that you don't want to forget to do. You know, you need to do the planning. And that's early starting, good habits, and fun plans. I'll tell you this, and this is Jeff, this is jumping out of line a little bit. I can tell you where physicians accumulate most of their wealth. I mean, besides the medical building or the nephrology centers, or, you know, or the something like that, but it's their qualified retirement plans, their pension, profit sharing, those type things, because the money gets taken from us. We do the same thing, by the way. It gets taken from us before we have a chance to spend it. Our employer takes the money and puts it in our 401k. And that's where you'll build a lot of money. And that is starting early and regularly. Go ahead, Jeff.
Yeah, I mean, now that you guys are all, this course is designed for younger physicians. For systematic savings in early age is key to all of it. Doing it in a tax efficient way. And then he kind of covered 3 of them real quick there. And then number 10, the asset allocation. You know, it's okay to trade a small portion of your money through your Robinhood app or your E-Trade account and buy some stocks on your own. But the big money should be managed by low fee institutional money managers in a fully diversified portfolio where you own 500, 600 different stocks. And we'll talk about that next week. But that's how you really accumulate wealth. Trying to time the market and jump in and out of stocks on your own doesn't really work. But to do it maybe for a small account for, you know, but
have fun, that's okay.
Yeah, some fun money. That works fine. All right.
Just to emphasize what Jeff just said, when you have an overall investment portfolio, okay, 91% of the return in that portfolio is not coming from when you bought that stock or a bond or when you sold it, or not even what the market's doing. 91% of the return in that portfolio comes from asset allocations, because guys like Jeff and I, we talk a good game, but you know, we really don't know what is going to be doing best this year or next year, because what's best this year may be all the way down here next year. Asset allocation is a secret to proper wealth.
And we will talk about that thoroughly next week.
Correct.
Number 11, this is just the what ifs. Death, disability. Disability is a big one.
Yeah.
Mike, you want to talk about the disability?
Yes. I can tell you the biggest asset that you have is probably not your investment account today. And will be. It's not your retirement plan. The biggest asset you have is your ability to practice, is your ability to work. And it is a tragedy. Believe me, Jeff and I are the one, we get the first calls when things go wrong. It is a tragedy when a physician becomes disabled. Well, when anyone becomes disabled, but because you lose your employer, you need to get, I don't want to get into this too long. You need good disability that will protect you in your specialty, but you need to protect that. You may have a need for life insurance also if you have a family and things.
We'll cover that. We're going to cover that in depth next week.
Right.
We're going to cover all the different types of policies. Okay. So we will get into that. That's extremely important. Ensuring everything you just worked so hard to get to. We want to make sure that you protect that. Take advantage of employers' plans. This is an easy one. We're going to talk about your 401ks, 403bs. Make sure you max those out first. We'll talk about that in a minute. Choosing the best way to take money out. That one's somewhat applicable. Really, if it's just rolling over money, at retirement, it becomes very important the way that you distribute your assets at retirement, but you're still far away from retirement. So we'll talk about how to execute a rollover, make sure you don't make any of those mistakes. We'll talk about that in a minute as well. And then estate planning. We've got an estate planning attorney coming in to talk about everything you need to know about estate planning next week. We're real excited about that. Mike, you got anything to talk about estate?
We're going to see with the new administration, there's going to be changes in the tax laws, and the state taxes are going to come back real strong, very strong.
Absolutely. So is debt working for you or against you? And this is as basic as, is your return on investment negative on your debt, or is your return on your investment positive on your debt? Mike, you want to cover some good debt?
Oh, I knew you were going to give me this one. I knew that was coming. Okay. So you can spend your money and you can have debt on buying a home. Okay. And because with that home, it'll appreciate in value. It's something for you're building equity all the time. So something like that is a great example of good debt. And then Jeff gets the fun part talking about the bad.
You know what other good? You're missing the most important type of good debt. School loans for to become a physician. That's
right. The number one voice emphasized that.
No,
that is good debt. Let me tell you, that is good debt.
That is good, really good debt.
Now have your fun.
Bad debt, obviously, taking a loan out for $300,000-$400,000 to buy a boat early on. Big boats and all that stuff are definitely attainable for you. but doing it early on before you can get your money working for you in passive income and working income and building that foundation of wealth, then it's okay to make those big purchases. But early on, it's extremely important to manage these decisions wisely, not get in over your head, not keep up with Dr. Jones, and live within your means and set your goals and save for those goals systematically and get that money in there. And then once you're established and got a nice nest egg underneath you, then it's okay to explore these options down the road. But right now, probably not the best idea.
And don't say that it doesn't happen. I literally 2 weeks ago had someone new out, got a job with a great practice. He ended up within the first few months buying this big house, buying the boat. Okay, so it does happen. Please don't fall into that.
Yeah.
Oh, here we go, inflation.
Just make sure you understand your situation and make sure you satisfy all your fixed income needs, and then see if that money's left over. We talked about inflation. Inflation is a variable that, particularly when you're young, you need to address, especially when you're setting your goals for yourself. Because $100,000 today, let's say I want to live off $200,000 a year in income, I need to adjust that for inflation every year. And that's going to be a lot more money 30, 40 years from now. This is just an example. $5,000 today at 3% inflation to buy the same goods and services, you would need $12,000 to do that 30 years from now. Okay,
Say that
so that's
again.
a big number. That's
how much? What's it? Say that again.
$12,000.
Are you guys listening to this? And that's only at 3%.
That's only at 3, right? You know, the average inflation is like 2.6, something like that. You want to use a more aggressive number when you're running your retirement calculations and you're setting your goal setting. So if it's, I want to live off $150,000 in today's dollars 30 years from now, as you can see, that's gonna be a lot more. You know, it's more than double.
Good point.
Yeah, absolutely. And this is just another way to look at it. At a 3% inflation rate, $1 today, 30 years from now, you need $2.42 to buy the same goods and services. At 4%, you need $3.24 30 years from now. So that's a big deal. If you're planning to, and you're starting to plan your lifestyle for retirement, you need to address, okay, well, here's how much I'd like to have in today's dollars. I need to grow that by inflation. This also goes into your risk planning for your investment allocation. That means that you got to do 3% just to break even in your portfolio. And then add taxes to that. You know, you may need to do 4 or 5 just to break even when you build in inflation. And that's why we're going to talk about risk profiles and stuff like that next week and how to build the portfolio. But it's kind of depressing when you look at inflation. You got to do more than 3 just to break even, you know, and then you add taxes in there. That doesn't make it any easier.
And the taxes, Jason will hit in a minute or so.
Yeah. So opportunity cost. What is that? What is lost opportunity cost? Well, there's a couple of aspects of that. That's by not saving now, how does that impact me on losing those dollars in an account of that future growth? That's opportunity cost. Spending too much money on a big purchase. You know, I know we said this a million times, but go out and buying a $500,000 boat. Well, if you took that money, instead of doing that and put it in an investment account and grew it over 40 years, you're looking at millions of dollars. This chart right here will kind of bring it home. Mike, you want to cover this hypothetical?
Well, how about 8% is about as high as it goes, right? All that this is saying is that if you just take $50,000, and that is not a lot of money, folks, and you put in $1,000 a month, which isn't a lot. If you do that, if you look down the bottom over 10 years at the different rates of return, over 20 years, the growth is unbelievable. And that is with a $50,000 investment and then $1,000 a month. And it grows to $2 million at 8%.
Yeah, over 30 years.
That's just the magic of compound interest and the magic of starting earlier.
Yeah.
Sorry, I'm going to move on.
Just even the growth from at 10 years, you get 300. At 30 years, you've got 2 million and you're doing the same thing. I mean, the power of compounding interest and for systematic savings, this is everything. This is by doing this early, Man, I'll tell you, it's going to make life a lot easier down the road. This is a big deal. Jason. Yeah, Jason's up next. Mike, you want to introduce Jason and give him a little background, and then he'll jump on?
Jason is a board certified CPA. He works primarily with physicians. He's been around for a while, maybe 15, 20 years, maybe longer.
24.
24 years. Wow.
24. I was pretty close. The firm he's with, Cohen and Grieve, as I said earlier in the meeting, they are a top CPA firm, especially for physicians. I'm not knocking any other CPA firm. I'm just saying these guys are excellent with physicians. So when you ask Jason a question, or when Jason's saying it, he's used to dealing with people just like you in situations that you may not have seen yet, but he's dealt with it. So he's a great person to listen to, but ask him questions, please. My pleasure, Jason Hamlin, CPA.
Hey, Jason, do you want me to manage the screen for you, or do you want to jump on, or what do you want to do?
Yeah, if you don't mind flipping the slides, we'll just stay on yours.
Let me know. I'll flip them.
Okay. So the first slide here is just a summary of the tax rates for the two most common filing statuses, being single and married filing jointly. And the interesting thing to kind of point out here is what's referred to commonly as the marriage penalty. And if you look at it up through about the 32% bracket, everything for single filers is exactly 1/2 of what it is for joint filers. But then if you go to the 35% bracket, the single filer has about a $300,000 spread between the bottom and the top of that bracket, whereas the married filer only has about a $218,000 spread before hitting the 37% bracket. So a couple of things on that. One is if you have two high income earners, you tend to get penalized for getting married from a tax perspective. If you have one high income earner and one, like, let's just say you have a spouse that stays at home or doesn't work outside the home, or has a lower paying job, then it can benefit them to go ahead and get married and take advantage of the married filing jointly rates, because at that point, then they can go up to 600, and the high earner spouse can go up to $622,000 of taxable income before they get out of the 35% bracket. So just something to be mindful of there, when just looking at things like, should we get married now? Should we not get married now? And that's one good question to ask your CPA or your financial planner, because they can go ahead and run that analysis and say, hey, you know what, if you do get married, this is what you're looking at. And if you don't, well, here's your taxes that way. So if we go to the next slide, we have the long-term capital gains rates for 2020. And as you can see there, those vary from 0%, I'll talk about that in a second, all the way up to 20% for both single and married filing jointly. Again, there we actually see a higher marriage penalty, because the 0%, while being twice that for married filing jointly as it is for single people, so basically 0% on taxable income up to $40,000 for single or $80,000 for married filing jointly, then that bracket there goes from $40,000 to $441 for single and $80,000 to only $496. Whereas if it was double, you would expect it to go to about $880,000. So again, a little bit of a marriage penalty there for capital gains. The other thing to point out is a lot of times when people are looking at planning their capital gains, they fail to plan for what's called the net investment income tax. And that was something that was 2 administrations ago, it originated. And basically what it was imposing kind of another Medicare tax on the sale of investments, kind of trying to make up some revenue shortfalls. And basically the way they get to that is they look at both sides of the Medicare tax at 1.45% plus the Medicare surtax, which is another 0.09%. That's how you get to the 3.8. So it's just something to be mindful there too. I mean, when you're selling something, a house, a rental property, whatever it is, if you're selling it for a gain, be mindful of that additional 3.8%, because it can make a big difference in your calculation. So if we go to the next slide, it'll be understanding our marginal rates. And one of the things there to keep in mind is all of your income is not taxed at your marginal rate. It's only the income within that marginal rate spread or bracket that gets taxed at that marginal rate. For instance, if you have, take Maria, for example, she earns $100,000 in 2020, single filer, and she takes a standard deduction of about $12,400. She's in the 24% bracket. But as you can see there, a portion of her income is taxed at 10%, 12%, and 22% before getting to the 24% bracket, where only about $500 of tax results from that bracket. So next we'll talk about 12 strategies to minimize wealth destroying taxes. And these are some general rules. They're not necessarily hard and fast on all of these, and we can kind of talk about some of that stuff as we go along. The first one, and this is a hard and fast rule, is participating in your employer-sponsored retirement plan. As Mike and Jen were talking, go ahead. Oh, sorry. Say that's the best way to save for your retirement. Save early and often, and save as much as you can now. And each time you get a bump in your pay, go ahead and put that toward that retirement plan first, because then you won't miss it. It'll come out, you know, obviously from your check before you ever get that net. So it's not going to tempt you. It's not going to, you know, sit there and say, hey, you know, take me out, spend me on something that you shouldn't really spend me on. So the long-term benefits of that employer-sponsored retirement plan are, as it says there, tax-deferred principal and earnings growth. Now, a key point there is the earnings growth is not necessarily tax-free; it's tax-deferred. Your principal, you're paying tax on now, so you'll pull that out tax-free, but your earnings you're going to be taxed on unless you go with a Roth option on your retirement plan if one's available. The next step is to use the capital loss rules. And with that, you can use up to $3,000 in net capital losses to offset earned income or qualified dividends. So if you have a $50,000 capital gain, and let's say you've got a $75,000 capital loss, you can use $53,000 of that loss to get to a net $3,000 loss, and the other $22,000 will be carried forward to offset future capital gains. That's something, you know, too, that you'll want to work with your financial advisor and your CPA in tandem on, you know, in determining, how you plan to sell stocks, when you sell them, that sort of thing. And it's, one of the things you'll often hear a lot of times is your investment advisor. Some of them might say, hey, you know what, let's do some capital loss harvesting, which can be a good thing, but it can also be a bad thing. You want to make sure it makes sense economically to sell those securities and take a loss on them. You want to make sure those are ones that you don't anticipate recovering at any point. And that's a good general thing to keep in mind with these 12 strategies is these are great in terms of tax strategies, but you've always got to make sure that the economics of the situation makes sense before you look at the tax side of it. So the next
Jason, the 1 year holding period plays a big role in this as well. Why don't you explain that a little bit? How if you sell it before the year, it's ordinary income. If it's over the year, it's long term.
Yeah, exactly. Yeah, if you hold a security for a year or less than a year, and you sell it, you're going to pay short-term capital gains rates, which are taxed at your marginal tax rate. So if you're in the 35% bracket, you're paying 35% on that stock, plus potentially that 3.8% net investment income. So you can pay, if you're in the top bracket of 37%, you can pay up to almost 41% on the gain on sale of a short-term investment versus long-term. Well, you hold it a year or more, and you can pay anywhere from 0% up to 23.8%. But even worst case, assuming you're in the top tax bracket, you're saving 17% versus the short-term capital gains rates.
Right. Good point.
So point 3, contributing to a traditional IRA. Again, similar to a traditional employer-sponsored retirement plan, the 401k, the traditional investment vehicle there, you get the long-term tax benefits of tax-deferred principal and earnings growth. Obviously, there are, as you guys are well aware, Roth IRAs. And before you get into deciding which to do, a traditional or Roth IRA, that's when you sit down with Mike and Jeff and discuss and say, hey, what makes sense the most for me to do here in this situation? Point number 4, contributing to flexible spending accounts. That allows you to set aside pre-tax dollars for qualified healthcare expenses. The most notable being your health savings account or HSA nowadays. And those are really great ways to deduct some medical expenses, because as you guys will quickly learn on your tax returns, medical expenses are an itemized deduction, which is harder to get to nowadays with the increased standard deduction.
Right.
But then even over and above that, you have to surpass a floor, which is 10% of your adjusted gross income, able to start deducting those healthcare costs. So you use, for example, on an account, you can't use insurance premiums. You're already going to be paying those with pre-tax dollars from your employer-sponsored plan, but you can pay things like co-pays, prescription costs, that sort of thing, which then effectively renders those items paid for with pre-tax dollars. One thing to keep in mind with flexible spending accounts, especially as it pertains to things like dependent care benefits and certain other savings plans through your employer, is going to be the use it or lose it concept, where if you don't spend that money by the end of the year, you do lose it. One other point on the dependent care benefit side is to make sure that both you and your spouse, if you're married, are you're both working or looking for work, because otherwise what happens is that dependent care benefit comes back into taxable income as basically as taxable wages. Something to be mindful of. So number 5, adjustments, deferrals, and credits. Student loan interest. As Mike and Jeff pointed out, you guys are probably intimately familiar with student loans. You may be able to, in the first, maybe second year of probably residency and in your profession, hopefully not too long into your career, take advantage of the student loan interest, because it does phase out pretty quickly. Child and dependent care expenses. If you're not doing dependent care benefits through your employers, there is a credit for child and dependent care expenses for anybody, making anything over a minimal amount of income. It tends to be about 20% of the first $3,000 per child, limited to limited to $1,200 in total. The adoption credit can be some significant dollars, nowhere near what it costs to actually adopt a child. The foreign tax credit is available for when you pay foreign taxes on dividends, typically through an investment account. You'll find that on 1099 at the end of the year and whatnot. The tax laws at the end, or I guess the beginning of 2018, end of 2017, eliminated a lot of the other adjustments, but there are still a bunch of them available. The earned income tax credit up to $6,600. Hopefully you guys aren't going to be hopefully you guys won't qualify for that. The child and dependent care credit, again, up to $6,000, but again, because of your income, you guys are most likely going to be limited to $600 per child with a maximum of $1,200. The adoption credit is up to $14,300. The Hope Scholarship credit, which is now called the American Opportunity Tax Credit, is up to $2,500. Student loan interest, you can deduct up to $2,500. And it's important to mention that student loan interest is a deduction as opposed to the 4 above it, which are credits, credits being dollar for dollar reductions in your tax liability. Transportation and parking benefits up to $270 a month. That's kind of a limited and somewhat unusual deduction. And then medical savings accounts, the most common version of that now being the health savings account. The medical savings accounts aren't as much used anymore. So we go to the next slide, number 6, itemizing your deductions. And as I mentioned before, it is more difficult to itemize nowadays just due to the fact that your standard deductions are much higher. The Tax Act at the end of 2017 / beginning of 2018 eliminated the dependency exemptions and essentially doubled the standard deductions. So for single, it's now $12,400. It used to be, before going back, it was about half that. Married filing jointly, the same thing now. It's almost $25,000, and it was about $12,000 when it changed. So it's one thing where you do have some limited planning opportunities. You may want to look at possibly doubling up on deductions in odd or even years, just so that you might, if you're on the cusp where you only benefit a little bit from a standard deduction, or I'm sorry, from your itemized deductions, or don't quite make that cut. Sometimes you can double your charitable contributions into even or odd years, or if your tax deduction is less than the $10,000 cap, you can consider doubling up on real estate taxes as well. And that may get you to the point where you benefit more from your itemized deductions. So that's where you would consider that. And then number 8, knowing when to convert your IRA. And here I'm just going to say one thing, talk to Mike or Jeff. They're the ones that are going to be able to give you the economic benefits of doing that. I will tell you, last year presented a very unique opportunity for people when their incomes were down. And this is something you guys may want to consider while your income is lower. They were able to convert a lot of traditional IRA over to Roth IRA and stay in relatively low tax brackets, which then was very helpful.
We're going to cover that.
Hey guys, just to jump in for a second, you know, some of this stuff is kind of high level for med students, like some and that's not to underestimate the med students, because some med students have run businesses and are very financially savvy. But I don't know if you guys want to check in with them and see if they have any specific questions around this, especially the tax stuff. Some of it can be a little, you know, if they're not working, if they're not used to business kind of stuff, it might be a little over some of their heads. So just if there's any questions, you know, feel free to jump in, you know, guys. I
believe that the people that are on this call are actually in practice physicians aged 35 to 45. I don't believe there's any students on this call.
Well, thank you for that.
I will second that. This was not presented for them. This is done through Hillsborough County Medical Association. That's why we did it. We have other classes for the students who visit. Yeah.
When Mike was talking about that, that's a separate whole nother, that we do that at the medical school. This is actually, everybody should have been in practice for a while now on this call.
Yes.
I got you. I apologize. I see there's a message in the box saying that there's a resident on that appreciates the content and the level. So that's perfect. I just wanted to make sure that we were hitting the mark with all that. So
yeah, it's designed for creating wealth in an early stage. But you're right. Some of this tax stuff is complicated. But
yeah, even for me, I've been out 10 years and trying to get some of these nuances. It's important stuff, you know what I mean? And so if you go through it too quick, some people's eyes can glaze over a little bit. So
yeah, absolutely.
I just want to make sure everyone was good.
Anything, anyone has any questions, you can question us through the chat line. And if anything pertains to you, you have the opportunity to call Jason, ourselves, with any questions that if something is a little bit much for you, just jot it down. Send us an email and we'll get back to you within a day on any questions that you have on any of this stuff as well.
Absolutely. And I'm happy to, I mean, similar to what Mike and Jeff do, I'm happy to sit down with you guys at an initial meeting. You know, we don't charge for that. Happy to answer any questions. Give me a call. Again, Mike and Jeff have our contact information and I'm happy to help you out with any of that stuff. So I do know it is a lot. Quite frankly, thanks to our elected officials, and this is on both sides of the party lines. They have done a good job over the last few decades making the tax laws so complicated that we spend a good amount of our time just making sure that we are up to speed on them. So I definitely can empathize. So point number 9, use tax advantaged accounts for active trading. Those are going to be your 401k, IRA, et cetera, so that you know, the idea being that your gains and whatnot can be in there and be tax deferred versus outside of that where you may want to have more growth stock or growth investment type of vehicles. Number 10, timing your purchase and sale of mutual funds. This is something that if you want to get more in depth with, you can talk with Mike and Jeff, but it's basically purchasing a mutual fund after distribution to avoid taxation on the capital gain distribution, which typically happens at the end of the year. Likewise, selling the mutual fund prior to the distribution so that you also avoid that capital gain.
I think that's one of the ones that are a little bit, that one might be a little high level.
Yeah, that's going to situation. A little funky. So that's one where you know, want to talk with Mike and Jeff because they can kind of walk you through that as far as what makes sense for your situation. Number 11,
that
pay
is
estimated.
a very important thing that you just said about timing distributions, but not
very complicated.
Yeah.
So number 11, paying estimated tax payments. The big thing here, most of you guys will be, or most of you guys and girls, gentlemen, ladies, will be in W-2 positions, but there may be situations if you're invested in other activities where you may also need to make estimated tax payments. That's where you're going to want to consult with your CPA to make sure that, hey, am I paying the right amount? And that's typically going to be based on your prior year tax so that you can avoid a penalty, and that penalty being on the amount of tax that you've underpaid. Number 12, purchase instead of renting. Real estate tax and home mortgage interest deductions are some of the benefits of that. And you can get up to $500,000 in tax-free capital gains for a married filing jointly couple, as long as they've lived in a house for 2 of the previous 5 years ending on the date of sale. Yes, from a tax perspective, that can be good. That can also be that good kind of debt that Mike and Jeff were talking about before. The one caveat on that, as I would say, is just make sure that, again, you're aware of your situation in terms of, are you staying put in your practice? What does your non-compete look like? That sort of thing, because you don't want to be stuck where you've purchased a house and for one reason or another, you can't get rid of it. Although in this market, it's kind of an unlikely scenario, but you just want to make sure that you're aware of your situation to make sure that you're secure in that. So if we go to the next slide. So the tax exclusion from the home sale gain, again, that's up to $500,000, and you have to pass the following tests. You've got the ownership test, where again, you have to have owned that house for at least 2 of the previous, you have to have owned it for at least 2 years. The use test, the previous sale tests were basically, you haven't done that within the past 2 years. You haven't used that gain. And the joint filer test. So the joint filer test is basically ownership only has to be one of the 2 people, but the use test has to be both of those people. So both of the joint filers would have had to use the home as their primary residence within for at least 2 of the previous 5 years ending on the date of sale of that home. And with this whole home sale thing, it's important to make sure that you've done your homework and established your residency exactly where you want it, or your homestead exactly where you want it. Again, if you own multiple homes, don't try and get cute with things and whatnot. Look at it realistically and say, hey, what are my goals with these houses? Am I going to sell one? Am I going to live in one? What's the scoop? We've had instances where you've had 2 spouses, one tries to homestead one house, the other house, and the counties catch on to that pretty quickly these days, and that doesn't end well. Another concept is the alternative minimum tax, and this one I will gloss over at about a 50,000 foot level. The AMT is essentially as it says, an alternative taxing structure that runs parallel to the traditional tax laws, and basically what it was designed to do was make sure that high income earners aren't getting out of paying their quote unquote fair share of taxes. Prior to 2018, there were a lot of add back and preference items, such as unreimbursed employee business expenses, things like that. Capital gains can trigger it. Exercising incentive stock options, that's a big one as well. I'll talk about that in one second. But the main thing to point out is that the threshold or the exemption for the AMT has increased substantially starting in 2018, and a lot of the preference items were actually eliminated in 2018. But the capital gains thing is a big potential trigger of it, and the incentive stock options. So if you happen to end up working for a company, or your spouse works for a company with incentive stock options, and you exercise those stock options in a given year, but you don't sell them in that year, the difference between the strike price and the grant price is an AMT preference item. I was actually just looking at that for somebody this morning who was looking at up to $1 million of an AMT preference item just on one exercise of some stock options. So it's a big deal. Again, the exemption being, yeah. So here are some of your amounts. These aren't going to mean anything really right now, but essentially it's when you start to get out of the phase out of these, I'm sorry, you phase out of the exemption at these income levels, or these taxable income levels, the 518 and then the 1,020,000 for married filing jointly. So it's just something to keep in mind. So we can go to the next slide real quick. And actually, I am done. Does anybody have any questions for me? Or if you do and you want to ask them privately, again, feel free to reach out to Mike or Jeff for my contact information. I'm more than happy to answer those questions and see if we can help you out.
Yes, let me emphasize that if there are any questions that you need to ask and they're personal, which most of this, all of it is, confidentiality is, to say the least, we live by that. And you can ask any of us anything. And we'll get you in touch with Jason.
Yeah, there was a question.
There is a
about
question
HSA.
in the, oh yeah, sorry, go ahead.
Yeah, there was a question. Somebody had a question about an HSA. How do I know if my healthcare plan allows for this? As I thought you needed a certain level of deductible.
You do. You do have to have what's called a high deductible plan, a health plan, or an HDHP. And typically what will happen is when you're getting the options for that, for your health insurance, what plan to select, it will typically tell you, hey, this is an HSA eligible plan. And if you're unsure, what you would do is either ask your HR person or, if you're dealing with an agent, ask the agent, and they'll be able to guide you on that.
Okay. Well, thank you very much, Jason. And
No problem.
If anybody has any questions for Jason, just email us and we will forward. We'll send you his email and we'll get back to you as soon as possible. We're running a little late here, so we're going to continue on with the conference. Thank you, Jason.
Thank you very much, Jason.
All right. We're going to get into retirement plans, 401ks, 403bs. Mike, you want to talk about the importance of paying yourself first and the importance of 401ks?
Yes, I could talk about that all day. The person that's going to finance your retirement is the person you see in the mirror every morning. That's who's going to do it. However, there are ways to have others help pay for it, and they're your employers, whether you're acting as the employee in a relationship or whether you are the employee and the employer. There is a way for your employer to help fund your money. I know we said this earlier in the meeting, and please excuse the repetition, but a 401k plan, a 403b, 457, they're all what are called qualified plans. What that means is the money that goes into them basically goes in as a tax deduction. You can use a Roth option and not take the deduction, but we discussed that earlier. A 401k is the normal type of retirement plan you're going to see in a regular employer. 403b, you're going to see it's with the hospitals. You'll see that. 457s will be not-for-profits. There's also plans, special ones for teachers, but they're basically the same. It is a way for you to put money away and you have the choice of a tax deduction. It is also a chance for you to get that matched. And the best thing that you can do is fully fund the plan. Jeff, go ahead.
So 401k and 403b operate exactly the same. One's for nonprofits, one's full profit. So when you have one of these plans, you want to max it out if you can to start. You first want to make sure your emergency reserve is funded, and you also want to max out your 401k, 403bs. You can do $19,500 if you're under age 50. And then the next decision you have to make is, do I want to do Roth contributions or do I want to do traditional contributions? Just a quick and easy way to understand this. If I do traditional contributions, if I max out at $19,500, I get a deduction off of my income. So if I made $100,000 minus out the $19,500, that's my taxable income. So it helps lower my taxable income. So over my lifetime, let's say I've deducted $500,000 of contributions to my plan. It's grown to $1 million. At age 59 and a half, I'm able to start withdrawing that money without a 10% penalty. However, everything coming out is taxed as ordinary income, and that rate is based on where you stand in that tax bracket that Jason showed you earlier. All right, I get a deduction over the years, but everything is taxable to me on the way out. On the Roth side of things, same contribution limits. I can do $19,500. I make $500,000 of contributions over my life, but I've never gotten I don't take a deduction off my income tax, right? So big difference there, no deduction. Here's where it really works well. If you put the $500,000 in and it grows to $1 million, that whole $1 million is completely tax-free to you.
Completely tax-free.
Completely tax-free. So if you're in your 30s, 40s, and you've got 30 years, 40 years before you're gonna start withdrawing that money, all of that growth is completely tax-free. So it's got to be a really compelling argument for me to take a deduction versus not take a deduction. I take the deduction, I pay tax on the growth. I don't take a deduction, all tax-free to me. All right, so I've got a 401k. I'm going to max it out. Which contribution method am I going to use? If I use Roth, we understand how that works. If I use traditional, we understand how that works. Mike talked about matches. When your employer matches your contributions, that is always going to be taxable to you on the way out. The employer takes a deduction for giving you those contributions. So let's say I've only done Roth contributions in my 401k. Great, I've got that bucket of money I can take out tax-free. All the matches in a separate bucket that will all be taxable to me, right? That's the matching contributions and growth. Now, when they give you a match, they don't let you just walk away with those dollars. They put a vesting schedule on there. And that means that there's a set period of time based on the plan that if you walk away from employment from that company, you don't get to keep all the match. It's usually around 7 years, you're free and clear. You're always able to walk with your contributions. Their contributions, there's a vesting schedule. So make sure you're aware of that.
As we're, okay, Jim, I'm sorry.
Yeah, I'm good. Go ahead, Mike.
Okay. One of the things to realize when you're talking about retirement savings, you're going to hear a lot about taxation. We're all going to talk about different types of taxes, tax advantages, tax disadvantages. When you're talking about retirement, you're talking about two different mental stages, two different life stages. When you're funding a plan, okay, like right now, your CPA, you know, your advisor may be saying, get as much as you can in the tax deductions, okay, because that's something you're going to get today. But the real part of investments, and one of the reasons you hear Jeff and I and others spiel the praises of Roth, is that the other part of retirement isn't when you're putting the money in, it's when you're taking the money out. And that is the most critical time in your life for taxes. That's not when you want all the taxes, because you don't know what your situation you're going to be in when you get older. If that money's coming out tax-free, it's a gift. It's a wonderful thing not to be paying that taxes. Now, I'm not saying don't fund anything but a Roth. I'm not saying that. I'm just saying don't discount the value of tax-free dollars that Jeff just discussed. Don't discount that, because when you go to retire, that's going to be paramount.
Yep. Just a couple things before we move on from 401ks, 403bs. All the dollars in there are creditor protected, which are extremely important for physicians. Any money that you put in there, no one can ever take away. Extremely important. So I've made the decision. Maybe I'm going to max out, or maybe I'll just do the Roth. That's great. Inside the menu of your fund choices, you've got a bunch of fund selection that you have to choose. You can usually consult with your advisor to try to give you some guidance on that. What's real popular in those accounts are what's called target date. You'll see a lifestyle or target date fund, and it'll automatically usually default you into the fund that puts you at age 65. So that will act as if you're going to retire when you're age 65. It's that simple. It automatically will rebalance every year and get you more conservative as you approach age 65.
Yes, the closer you get to that age of retirement, the more conservative the portfolio automatically becomes.
Yeah.
So like if a client says to us, well, Mike, well, Jeff, what should I use in the fund categories I have in my employer? And they show it to us and it's maybe not the greatest. We'll say, use the target date funds, because they're going to be more aggressive for you, but they will automatically become less aggressive as the years go on.
So let's talk about if you switch jobs, what are your options to do with your 401k? Sometimes you can leave it in the plan. Sometimes you can move it to your new plan and consolidate. If you like the menu of choices inside there, you can probably move it into your new employer's plan. What we recommend is just moving it into an IRA, developing an asset allocation. You have full control and buy whatever you want inside the IRA account. And then you have control of that asset, and you're not just limited to the fund choices inside the plan. What you don't want to do is take the money out in any way and have the check made payable to you. They have to withhold 20%. Then you've got only 60 days to get the money that they withhold for taxes back into the account. It's an absolute disaster. So don't
And nobody
do that.
makes the 60 days. Nobody does. And they
No.
all get penalized. Don't ever do that. Listen to Jeff very carefully here.
Yeah, here's the mistake we see people make. Well, you know what? I want to roll it over, and they're going to say, who do you want the check made payable to? And you say, well, I'm not sure where I want to put it yet. Just send it to me. And if they do that, they have to withhold 20%. And that's where the nightmare starts. So know where you want to put it. Do a nice direct rollover to an IRA. Do not have the check made payable to you, and you'll be fine.
Do not do it yourself. Get a professional in there with you.
Talk to an advisor.
Yeah.
All right, let's just talk about traditional and Roth. We kind of talked about work from a taxation standpoint. You know, we don't see a lot of physicians don't qualify for deductible contributions to traditional IRAs.
Income's too high. That's normal.
Yeah, income's too high. And what is an IRA? It gives you the ability. This is aside from your 401k or 403bs. This is a contributory account that you can open and make a deduction in a traditional sense only if you qualify, which means you can't make a lot of money. So here's the phase out. If you have a plan at work and you're maxing it out, can I make additional contributions to an IRA? The answer is, if married filing jointly, you have to make less than $104,000 a year jointly to make a deductible contribution, and less than 65 as a single filer. All of you on this call are probably, if not already there, over this number.
Yeah, you're not going to see it.
Yeah, you're probably not going to be able to do that. Now, Roth, they're a little bit more appealing in the sense of, can I do one or not? Married filing jointly, less than $196,000, you can do a Roth. There's a phase out. If you make less than 206, you can do a partial contribution. And on a single filer, anything less than 124, it's full. And in between 124 and 139, it's partial. So, and most of you are going to be out of the game on this one too. Now, there's something called a backdoor Roth.
Good. I wanted you to cover that. Good.
Yeah, and that one, a backdoor Roth is we do this for a lot of physicians.
Especially residents and fellows that may be moonlighting or something like that. Their incomes aren't real high yet.
Well, even if they are really high, you can still do it. That's the whole point of the backdoor.
Get high.
Yeah. Even if you make a lot of money, this is a way that what you do is you make a non-deductible contribution to a traditional IRA, and there's no income test, there's no income cap on a non-deductible contribution, and then you immediately convert it to a Roth, and that way you can do that each year and get the money into the Roth account, and you bypass the income limitations on the Roth. Now, if you've got other IRAs that you've been funding over the years, the back door gets a lot more complicated. Call us on it or talk to somebody about it. You may still be able to do it, but it gets a little funky on the way to do it. Yeah, it gets more complicated. So the Roth's a great option. We know the taxation is all tax-free on the way out. Can I do one? Well, maybe you might be able to do the back door, depending upon a couple different variables, but it is an option. The other option that you have is that if you had existing other IRAs that you took deductions on, you can convert those into Roth IRA. So let's say I did have 100 grand already and I've made deductible contributions, and I wanted to make that a Roth. I can do just a regular conversion in a year. So let's say I only want to do half of it. I convert half of it. I have to pay the tax on that $50,000 I can.
Whoops. And see how long this lasts.
You want to jump in, Mike, and kind of take over there for a minute?
Yeah, who's
Looks like his
moving the
computer
slides?
froze.
Is it you or Jeff?
No, it's Jeff.
Okay, well then, let me just go to some notes. Right on a Roth conversion, he pretty much covered it. But the thing you have to be careful on a Roth is that if you don't want to, let's say you've got 100,000. He was referring to $100,000, and you wanted to convert it to a non-deductible Roth. It doesn't make sense to say, okay, just take that money out of that 1,000 I have and take that out and pay the taxes. When you do that, the method that they use to do it, that you're going to get double taxed. So if you're going to do a Roth conversion, the best way to do it is to have money aside, not in that other IRA, take from other accounts to pay the tax. Otherwise, you're going to pay double the tax. He was getting ready to say that. Very important thing. Just don't, make sure you go to a professional. I know I say that a lot, but you don't want to mess around. We love Roths. But they have got to be done properly. If you don't have the money to pay the tax to change it into a non-deductible Roth, don't do it. Okay. I don't know if we have him back yet.
Yeah, it looks like he's back.
Okay,
I think
Jeff.
he's probably pulling the slides back up.
Yep, I can see now. Sorry for a delay. Are there
Can you
any
speak up,
questions?
Mike, can you let everybody know what are the limits on a backdoor Roth as far as the contribution limit? Do you know that?
I don't have them here because they just changed them.
Yeah, no, it's the same. It's the same amount. You can do the $6,000 to
As a regular IRA.
the non-deductible IRA contribution, and then you convert it. So it's limited by the IRA cap, contribution cap. Now on a conversion, there's no limit. If you've already had $100,000 in your IRA, you can convert it. Or maybe you switch jobs and you rolled 100,000 into your IRA, you can convert it, and you can convert all of it if you wanted to. On the back door, it's the income contribution limits is the cap.
And the important thing, Jeff, I told him while you were in Neverland, was don't use their $100,000 to pay the tax. Take that tax from somewhere else, how important it was. Go ahead. Continue where you were then. Don't. Okay. Go ahead.
Let me jump back up to where we were here.
Yeah, let's try to finish up.
Yep. I don't know what happened there. I got kicked off. Okay, well, we're almost done. All right, so the Roth, the backdoor option, if you make too much money, that's a contributory. A conversion is you already get the money in the traditional and convert it to Roth. Both times you have to have the money outside to pay the tax.
Right, definitely.
SEPs and simples. Simple is you're only going to see these in a small startup maybe, or a small practice, or if you start a practice and you want, this is like the beginner level plan. There's lower contribution limits, but the administration is very simple.
Yeah, you don't see them that much anymore because you don't see with physicians especially.
Yeah,
because there really aren't starting as many small private practices anymore. At one time, most people went into private practice. Today, they really don't. They just join groups. Some do, but not many. And the SEP IRA, simplified IRA, that's a way for a small business, as Jeff just said, it's a way for them to put away extra dollars and not be penalized for it. They can do that, but you just don't see that many around anymore, do you, Jeff?
No, simples are kind of a dying breed. Don't see them. Usually 401k costs, administration costs have gotten so low that pretty much everyone just starts off with a 401k now due to the fee compression in the industry. Now, SEPs are a very interesting situation. If you're moonlighting or you've got a side business or a consulting business, you're able to sock away 25% of that income. So let's say you had some 1099 income that you were getting and you're maxing out your 401k, you can do up to 25% of that. So you could do an additional $25,000 because 25% of the 100,000 of extra income that you had, you can dump that into a SEP, take the deduction, and still max out your 401k. So in those interesting situations where you're making money in addition to your W-2 income at the hospital or wherever you're at the practice, you can then, if you've got some moonlighting or things like that on the side, this is a way for you to save more money.
Yeah, but you have to be careful. Yeah, you have to be careful because a lot of the practices now, they're not as free on that. They don't like you to moonlight. Sometimes they make it part of the contract. So if, you know, just make sure if you're doing this via moonlighting, because and that's who used to use these plans a lot, make sure it's okay with your practice. And believe me, they let you know right away when you join the practice.
Yeah, we've seen some people who do like consulting for like medical device manufacturing and things like that. That could be a side deal, especially if you're the designer, things of that nature. This is a way that you can sock away more money into the SEP. But in the beginning levels, unless you're in one of those unique situations, they don't play a huge role starting out. You're going to fund your money in your 401ks, 403bs. And then after you've maxed that out, we'll talk about some other funding strategies. The key to those, though, are asset protection for physicians is paramount. That's a huge, huge deal. No one can take that money from you when you get sued.
Right, and we'll talk about that more at the next session. But with our clients, we make sure that pretty much everything they have is asset protected because you're going to be sued. I think the lawyer said the average time you're going to be sued above your limits is 3 times through your career. And so in your planning, and we didn't get into that today, you need to make sure that your assets are asset protected from people that are going to come after your money because they see that you're a physician and they're coming after you anyway.
So just to recap, what we covered tonight was the importance of developing good habits, getting a net worth statement, getting a cash flow statement, which we can email you if you want one, understanding budgeting, understanding not spending over your means, understanding goal setting, setting retirement goals, college funding goals for the kids, maybe a home purchase goal, and then on those and making sure you understand what that monthly number is going to look like, and don't get in over your head because once you buy that big house and that big boat, it's hard to tell the kids we're downsizing, we're going to sell the boat. It's a really, really challenging situation. So make sure you gradually progress into those things. We talked about taxation with Jason. If you got any questions at all, let us know on that. We talked about 401ks, 403bs. That's a great place to start funding your dollars after you've funded your emergency reserve. Get all that money in there. And then we talked about IRAs. The back door is a hot one. That's what a lot of people are using now. And next, Mike, did you want to cover anything that we talked about? Anything to add before we wrap up?
I just want to say one thing because we're at the end of the conference right now. If you learn anything, please start to systematically save now. Learn how to steal from yourself fully. And the number one way to do that is to just check with your employer, your practice. And ask them this question, am I fully funding my retirement plan? And whatever it is, make sure you are fully funding your retirement plan. You'll thank us someday for that. Fully fund your retirement plan at work.
Even the goal setting, systematically save for those goals. All these investment institutions will take your money on a monthly basis, swipe it right out of your account, do it monthly, nice and easy.
You don't even miss it. You're right.
Yeah. So next week we've got a really good user-friendly class. We're going to cover all the different type of risk management. We're going to cover investments from the ground level up, and then we're going to have an estate attorney come on and talk about the essential documents that you should have now. Maybe you're starting to build a family and how to protect yourself from lawsuits and asset protection. So a great class next week. If you can't make it next week, I believe we will be recording these so we can email them over to you. Something we didn't talk about though is that part of our agreement with the medical association is that we waive our planning fees for anybody who wants to get a full plan done and cover everything we talked about over the next 2 weeks. I want to talk about it now in case you don't make it next week, but it's usually a $1,500 charge for us to do a full plan. Through our relationship, we've agreed through HCMA to waive that fee. So that's something that we'll send an email after next week that if anyone wants to take advantage of that, It's free. It's very thorough, and this will start to help you develop those habits that we talked about in tonight's class. So Mike, do you got anything else to say before we wrap this up?
I'll tell you this, we deal with medical organizations all over the country. HCMA takes care of you. They're really different that way.
Yeah.
Yeah.
Gentlemen, I just want to take a moment to thank you guys for your time. It was very useful information, really applicable, and thanks to all the participants for attending. We look forward to the next session, and just thanks for everyone. We're all busy, and this was really great stuff. Appreciate you guys.
Yeah, we will be on the same time, same place next week at 6:30 next Tuesday.